Picture this, you get paid on Friday. You do the responsible thing, you pay your rent, you cover your groceries, you set a little aside in savings, and then you look at what's left. $100, maybe less, and somewhere, someone told you that's not enough to start investing, that you need thousands, that you need to know what you're doing first, that $100 in the stock market is basically a rounding error, so why bother? So you don't. You let it sit. Month after month, that leftover 100 just waits in a checking account, earning next to nothing, while you wait for some future version of yourself who finally has enough to start. Here's the uncomfortable question underneath all of that. What if the amount was never actually the problem? What if waiting for enough is the thing quietly costing you the most? That's what this video is about. Not a get-rich scheme, not a secret formula, just an honest look at what $100 can actually do in the market today. Why the old advice about needing thousands to start is mostly outdated, and exactly how to put that $100 to work without needing a finance degree to do it. If you've ever felt like you were too small to start, stick around, because by the end of this, you'll know exactly where that $100 can go tonight. And if this kind of clear-headed money talk is useful to you, consider subscribing, not because I need you to, but because there's a lot more of this coming. Let's start with the one sentence that explains almost everything about why this feels confusing in the first place. Saving protects your money. Investing grows it. And those are two completely different jobs. A savings account is a security guard. Its whole purpose is to make sure nothing bad happens to the money you already have. A brokerage account is a gardener. Its whole purpose is to take a small seed and turn it into something bigger over time. You don't ask a security guard to grow your money, and you don't ask a gardener to protect it from a break-in. They're built for different work. And the confusion around investing $100 usually comes from applying the security guard's mindset to a job that actually needs a gardener. So let's do the math honestly, with round numbers, so you can see exactly what that $100 is capable of. Say you take that $100 and you leave it exactly where most people leave it, a standard checking account. Earning close to nothing, let's call it 0.1% a year. After 10 years, that $100 is worth about $101. It has, for all practical purposes, gone nowhere. Now take that same $100 and put it into a broad market index fund instead, something that owns a small slice of hundreds of companies at once, rather than betting on just one. Historically, over long stretches of time, the broader U.S. stock market has returned somewhere around 7% a year after adjusting for inflation. That's not a guarantee for any single year. Some years it's up 20%, some years it's down 15%, but smoothed out over decades. 7% has been a reasonable long-run average. At that rate, your $100 becomes about $197 in 10 years. It roughly doubles. Stretch that to 20 years, and it's around $387. Stretch it to 30 years. A single $100 deposit made once and never touched again, and it grows to somewhere close to $760 from one deposit. One decision, no additional effort. Now here's the part that actually matters more than the exact numbers. That difference, $101 versus $760, isn't the market being unfair to savers. It's not a trick. It's just two different jobs producing two different results. Exactly like we said. The checking account did its job perfectly. It protected the $100. It just was never built to grow it. And this is the psychological truth underneath the math. Most people don't avoid investing because $100 is too small. They avoid it because somewhere along the way they were taught that investing is complicated, risky, and only for people who already have money. So the $100 sits in the account doing its very safe, very static job, while the real cost, the growth that never happened, stays invisible. You never see a bill for it. There's no red number on a statement. It's just an absence. And absences are easy to ignore, right up until you add up 30 years of them. Now, I want to pause here, because I know exactly what some of you are thinking. But what if I put my $100 in and the market crashes? What if I lose it? That is a completely fair question, and honestly, it's the right question to ask. Anyone telling you the market only goes up is not being straight with you. It doesn't. It goes down, sometimes sharply, and there have been real periods, a year, sometimes several years, where the market lost value before it recovered. That risk is real, and I'm not going to pretend otherwise. But here's exactly why that fear, while valid, shouldn't be what keeps you on the sidelines. The risk with $100 in a diversified index fund isn't that you lose everything overnight and it's gone forever. Historically, broad market downturns have been followed by recoveries, sometimes taking a few years, but the long-term trend for the overall market has moved upward over most multi-decade periods. The real risk isn't a temporary dip. The real risk is panicking during that dip, selling at the bottom and locking in a loss that was only ever temporary on paper. So the goal isn't to avoid risk entirely. The goal is to make risk manageable and to build a habit that doesn't depend on your nerves holding steady during a bad news week. So let's break this down into something you can actually do, starting today in 5 simple stages. Step 1. Open a brokerage account. This sounds bigger than it is. Most major brokerages today let you open an account in about 10 minutes, entirely online, with no minimum deposit required to get started. You're not signing up for something complicated. You're just opening the door. Step 2. Buy a fractional share of a broad market index fund. This is the part that would have been impossible 20 years ago. In the past, if a single share of a fund cost $400 and you only had $100, you were locked out. Today, most brokerages let you buy a fraction of a share. So your $100 can buy exactly $100 worth of a fund, spread across hundreds of companies at once, instead of betting everything on one. Step 3. Automate a small, recurring contribution. This is where the real compounding magic happens, because a single $100 deposit is a nice start, but $100 every month is a completely different trajectory. Set it to transfer automatically right after payday, before you have a chance to spend it or talk yourself out of it. Step 4. Ignore the day-to-day noise. Once your money is in, the single most valuable skill you can develop is not checking it every day. The market will have bad weeks. It will have bad months. That's normal, expected, and priced in over a long enough timeline. Your job isn't to react to every dip. It's to keep contributing on schedule and let time do the rest of the work. Step 5. Increase your contribution as your income grows. You don't need to start big. You need to start. But every time you get a raise or pay off a debt, that's your cue to nudge the automated contribution up, even by $20 or $30 a month. Small increases, made consistently, compound just as powerfully as the original investment did. 5 steps. No complicated strategy, no market timing, no need to predict anything. Just a decision, an account, an automation, and patience. Now, to really understand why this works the way it does, it helps to step outside of money entirely for a second. Think about a single seed and a garden. If you hold one seed in your hand, it looks like almost nothing. You could crush it between 2 fingers without even trying. It's tempting to think, what's the point of planting just one? But that's not actually how a garden starts. A garden starts with exactly one seed, placed in the ground, watered consistently, and left alone to do what seeds naturally do. You don't dig it up every week to check if it's growing yet. You don't panic during a cold snap and yank it out of the soil. You plant it, you tend it on a schedule, and you let time and biology do the part that's outside of your control. $100 in the market is that seed. It looks small held up against the size of your rent or your future retirement. But it's not supposed to look big today. It's supposed to be planted today, so that 10, 20, 30 years from now, it's had enough time to become something you couldn't have built any other way. Not through effort, not through timing, just through consistency and patience. So let's bring this all the way back around. Saving protects. Investing grows. $100 left in a checking account for 30 years barely moves. That same $100 placed into a broad market index fund and left alone has historically had the potential to grow to several times its original value, and that's before you ever add another dollar to it. The 5 steps are simple on purpose. Open the account, buy the fractional share, automate the contribution, ignore the short-term noise, and increase it slowly as your income allows. None of that requires you to become a stock-picking expert. It just requires you to start before you feel ready, because ready is usually just another word for waiting. Here's the truth I want to leave you with. Security and freedom are not the same goal. Keeping your $100 safe in a checking account gives you security. It'll still be there tomorrow, exactly as it is today. But it will never, on its own, give you freedom, because freedom requires growth, and growth requires risk you've made peace with. The people who end up with real financial freedom aren't the ones who avoided risk entirely. They're the ones who understood which risks were worth taking and started small, early, and consistently. So here's my question for you. And I'd genuinely like to know the answer in the comments. Are you still standing on the sidelines, waiting for the right amount to start? Or have you already planted your first seed? Either way, there's no judgment. Just tell me which stage you're in, and let's go from there.